morning, everybody. Thank you all so much for being here with us today. Today we have an opportunity to have Jessica Burke with us, who's General Counsel and Executive Director for the Cabinet's for Economic Development's Opportunity Zone program. Jessica comes here. We've had members over the past year call us about an Opportunity Zone tax credit. What is this? Where can I develop and capitalize on this? And we're so glad that so many of you here today are here to hear about this great program. Owensboro has long been in the business of redeveloping our core districts, so this is an opportunity for you as business owners, as investors, and also as bankers and financial advisors to help your clients or yourselves queue into these areas where we can redevelop our community and also get tax credits that will enhance the overall quality of life and our economic opportunity here in Davis County. So we have people watching online too, and it's good to have you all here today. And I'll turn it over to Jessica Burke. And welcome to Owensboro.
And I get to put this down now.
So can everyone hear me? I don't know what to do without a microphone to hold. So thank you for coming out this morning. I appreciate you taking time out of your day, your busy schedules, to hear more about opportunity zones. It's something we're very excited about here in Kentucky. We think that they are a great tool for our communities. So I'm glad that you're here to learn more. Before we get started, kind of on the presentation, we have a video from the governor. He could not be here today, but he is very supportive of the Opportunity Zone initiative and wants to convey that to our communities. So we'll go to the video and then we'll get into the presentation.
Hi, this is Kentucky Governor Matt Bevin. Thank you for being here today. I wish I could be there with you in person, but I'm grateful for your interest in opportunity zones, your willingness to come out to learn more, to look at ways in which you can invest in making Kentucky the greatest version of itself possible. This came out of federal tax policy that came out in the end of 2017. And in April of 2018, announcements were made about these opportunity zones. And then in recent months, there have been announcements coming from Treasury that spelled out some of the details of exactly how these work. Kentucky is one of the very first states to apply for and receive approval for these opportunity zones. We have designated 144 zones in 84 counties. They are from east to west, north to south. They are in rural and urban communities. These are communities that have tremendous untapped potential, that have been historically more economically depressed than other areas, but sometimes just for lack of capital. Now there are financial incentives for people to be able to invest in these communities. Thank you for wanting to learn more. Ask questions, take notes, challenge one another, share information. Make sure you reach out to our Cabinet for Economic Development during the course of this session and the days to come, because we want to work with you to make Kentucky the greatest version of itself that it can possibly be. This is for people inside our state and outside who want to invest for a great return on that investment right here in the Commonwealth. We are Kentucky.
All right, and again, welcome to everyone here in beautiful Owensboro and all of you who are watching online. This will also be available on our website, kyoz.com. Afterwards, if you want to go back and rewatch it, or if you have other people who want to watch this presentation, and all of the PowerPoint slides and handouts that you've gotten here today will also be available on the website for download. So what are opportunity zones? How many of you here are familiar with what they are? All right, so that's good. A lot of you are completely here, completely new. So opportunity zones first came on the scene back in the end of 2017. So when the Tax Cut and Jobs Act was passed in December of 2017 by Congress, there were a few pages in there, a couple of provisions about opportunity zones. And basically what that law did is it allowed states to select certain areas within the state, certain census tracts, to be designated as opportunity zones. And those zones would be eligible for investment tax breaks. So if investors invest in those zones, those investors are eligible for some pretty significant tax breaks. And it's an incentive to get people investing in distressed areas across the country. Now that law gave states 90 days to select where opportunity zones would be in their state. And so you may you may have been aware back in the beginning of 2018, January and February, the Cabinet for Economic Development was very busy trying to figure out where these zones should be and trying to do it in the most data-driven, community-oriented. So the law, like I said, came out in December 2017. In March of 2018, Kentucky submitted our census tracts for approval to the federal government. Those were approved in April of 2018. And so these have been around for a little over a year now. Our designation is opportunity zones. Those are in place until December 31st of 2026. And so these opportunity zones, and we'll go through in just a second exactly how those were selected and where those are and how you can tell where they are. But those cannot be changed until December 31st, 2026. It would require a literal act of Congress. I've asked, it's not going to happen. But you can take comfort, they're not going anywhere, they're here to stay. So what was an opportunity zone? What qualified? What could we pick as an opportunity zone? We had some parameters that we had to follow that the federal government gave us. First, we could only pick census tracts as opportunity zones. And that's important because we've gotten some people calling us, because the opportunity zone, the boundaries may be a little weird. You'll have a downtown district and then you'll have out in the middle of the woods somewhere. The reason for that is we didn't get to draw the boundaries. The boundaries were set by the census tracts, which are determined by the federal government. And so we could say, census tract A is going to be an opportunity zone, but we couldn't do anything about the boundaries. So that was the first requirement, census tract boundaries controlled. Also, a tract had to have a poverty rate of at least 20%, or if it was in a metropolitan area, it could have up to 80% of the median family income of the areas around it or of the state, or if it was a non-metropolitan area, it could have up to 80% of the median family income of the state. So those were the parameters we were working with when we were selecting what could be an opportunity zone in Kentucky. There were 573 census tracts across the entire state that qualified as opportunity zones. We could only pick 25% of those. Again, that was part of the federal law. We could pick 25%. That was 144 tracts out of 573 eligible that we had to choose. 5% of those could be contiguous tracts. That was another mathematical formula. But we did wind up choosing 144 tracts. And here's how that happened. Again, we had 90 days to do this. And when we met to decide how we were going to pick where the opportunity zones were in Kentucky, what we did know is that we didn't want to do this in a way that was rewarding political friends or figuring out where our hometowns were or anything like that was subjected. We wanted to make sure we chose these opportunity zones in a way where we thought they would do the most good. So the first thing we did is we looked for pure data. There is a mapping tool called the Enterprise Mapping Tool. The Economic Innovation Group, it's a nonprofit, a national nonprofit. They put out this mapping tool that looked at every single eligible opportunity zone in the country, and they put out data metrics. And so we used that map, and we looked at basically what is the bottom 60% of our eligible opportunity zones in Kentucky. What are our neediest areas of our needy areas? And so we used that tool, looked at the bottom 60%, and from that purely data-driven, came up with what we called our ideal opportunity zone map. These are the areas that need the most help. But we also understood that data only tells part of a story, right? Numbers are only part of it. There are real people living in these communities that know these communities better than we at the state level do. So our next step is we sent a request for information out to cities, counties, judge executives, mayors, council members. Who sent it out through CAECO, League of Cities, anybody we could find to disseminate this information. And what that request for information asked for is tell us where in your communities would best benefit from being an opportunity zone. Where is there something to invest in now? Where is there something where could there be something to invest in if you got the opportunity zone designation? Because there's no reason to put an opportunity zone in the middle of a field that will always be a field, right? We wanted to make sure there would be opportunities there to make use of this. And we got quite a few responses back to that request for information. Some were individual counties, some were individual cities, a lot were regional collaborations from like Northern Kentucky, East Kentucky, the Louisville area. So that was our second step. Our third step is we went back to that mapping tool and we added in any census tracts that got new market tax credit investments. And the reason for that was that new market tax credit investments have similar eligibility criteria to opportunity zones. And so if a community had demonstrated that they could attract investments, we thought they could continue to attract investments using the Opportunity Zone initiative. So we added those to the map. And then the fourth step that we took, because remember, we could only pick 144 tracts, and at this point we had more than that. So to get down to the 144, any community that had not responded to our request for information, we took their tracts off of the map. And the reason for that is that the success of this initiative depends very heavily on local involvement, local developers, local government, local economic development. And so we wanted communities that were very engaged in the process. So that's how we picked the opportunity zones in Kentucky. I don't know all 144 off the top of my head, but if you have a question about how any of these were selected and you call me, send me an email at the office, I can look back at my notes and tell you exactly, using that 4 steps, how any of these tracts were selected. So after that process, we have 144 census tracts. They are in 84 of Kentucky's 120 counties across Kentucky. Those are spread out across Kentucky. There's an opportunity zone within driving distance of every single Kentuckian in the state. And you can see the map here on my left shows all the opportunity zones in green across the state. There's a map also on the PowerPoint overlaid with the roads. And if you want to know where these opportunity zones are, there are several good ways to find it. Go to kyoz.com. I will mention that website about 12 times today because that is our Kentucky-specific opportunity zone website. And all the information that we have about opportunity zones, as new information comes in, all goes on that website. And so if you go there, you'll see these maps, and they'll show you where opportunity zones are in Kentucky. So you have this map that highlights the zones in green and shows the roads. You'll also see this map. The counties that have opportunity zones are in yellow, the zones are in blue, and this works exactly like a Google map. So if you scroll down, click down into this map, it will take you down to street level. You can go to Davis County, keep clicking down, and you will hit this building, and you'll see whether or not it's in an opportunity zone. We also have these maps that will show you an overview of the counties and where the zones are within the county. So here's where we are now. You see the zones in blue up in the top of the county there. Here's Fayette County, just so you can see how another county looks. And this is what I'm talking about. If you scroll down, click down, you'll get down to street level. So this is in Lexington. You can see that the opportunity zone turned blue, and you see the borders of the zone there where it's white. That is not in an opportunity zone. By the way, that is Rupp Arena. Rupp Arena is in an opportunity zone. This is also in Lexington. You can tell there's no blue there. As we scroll down, that's all white. That is not an opportunity zone. That is Coach Calipari's house, by the way, not in a distressed area. We're all shocked. These maps also, and I want to show you, if you look at the top right-hand corner of those maps there, you see a little search bar. If you don't want to just click down into the county and scroll around to the streets, you want to know, say, if this building specifically is in an opportunity zone. Type in the address, the map will zoom directly to it. And you can tell if it's in an opportunity zone. If it's not, then you can move around, see where the nearest zone is. So very interactive map, very useful. So I told you that every state has opportunity zones. All 50 states, all U.S. territories have opportunity zones. So this is not something unique to Kentucky. What is unique is Kentucky is taking the lead in promoting these opportunity zones and making sure our communities know about these zones and telling investors that, hey, you have the money, we know you do, we're going to make it as easy as possible for you to take that money and put it here in projects in Kentucky. We have been invited to national conferences to speak on national stages because we're getting national attention for doing something good. It is recognized that Kentucky is at the forefront here. That's where we want to be. That doesn't mean that we are resting. It means we're working even harder to do things like we're doing here today to make sure that you have this information to go out and use it and do good things in your community. The Cabinet for Economic Development is in charge of promoting opportunity zones here in Kentucky. And again, kyoz.com, told you I'd mentioned about 12 times. I advise you and I encourage you to check it regularly to see what all is updated, what new information is out there. So now we know how the zones were picked. We know where they were. So the big question now is, how do they work, right? What is this? What's all the fuss about? So opportunity zones, there's not a grant if you're in a zone. There's no state money that we can give you. This is a federal program. What it is, though, is this is a way to mitigate risk for investors. And so if you are in an opportunity zone or your project is in an opportunity zone, if you get an investor into that project, whereas before an investor might be hesitant to invest in a distressed area because it's a riskier investment, it just is, than investing in somewhere else, this mitigates that risk by giving that investor some very significant tax benefits. So it makes investment in these distressed areas much more attractive to investors. So what you do to invest in these opportunity zones is you have to invest through qualified opportunity funds. And I know when I hear the word fund, I think New York, Wall Street, this is getting complicated and scary, but it's not. The federal government actually made something fairly simple. An opportunity fund is any corporation or any partnership that sets up a fund, and an LLC counts. That means that any one of you can set up me, LLC. It really is that easy. And then people can put capital gains into that opportunity fund and invest them into projects in opportunity zones. They have to be capital gains, that you can't put regular money into these opportunity funds and get the tax benefits. Only capital gains are eligible for the benefits. The opportunity fund, once they have their investments, then invest in projects in the opportunity zones. And those investments have to be either partnership or equity investments. They can't be loans. And the reason for that is this law is very much designed for long-term capital infusion into these communities to make these communities better, stronger, spur economic development. So what they don't want happening is a bunch of people putting money into these funds, making a bunch of loans to these communities, and then once they get their tax benefits, pulling all that money out, rolling off into the sunset. That doesn't help anyone, right? So partnership or stock investments into projects in the opportunity zones. So why would people invest in these projects? What are the benefits they get? Pretty significant. First, they get to defer paying taxes, which is something we all want to do. So again, you can only invest capital gains into opportunity funds. So say you have $100 in capital gains that you would have to pay taxes on this year. And I think there may be some developers, investors in the room. I'm an attorney, so I use easy numbers. So you have $100 in capital gains. You invest it into the opportunity fund. You then don't have to pay taxes on that money while it's in the opportunity fund. So you get to defer paying your taxes. That's good. Even better, if you leave that money in the fund for a certain amount of time, you get out of paying some taxes. So there's a step up in basis. If you leave your money in the opportunity fund for 5 years, you get a 10% step up in basis. So at the end of 5 years, your $100 original investment in the opportunity fund, you now only have to pay taxes on $90 of that instead of $100. At 7 years, you get a 15% step up in basis. So if you leave your money in that fund for 7 years, you have your original $100 investment, you now only have to pay tax on $85. So you've basically now made $15 completely tax-free that you would have had to pay taxes on. The really big benefit, though, is if you leave your money in an opportunity fund for 10 years, any money that grows in that fund, completely tax-free. So you put your $100 in an opportunity fund, you leave it in there for at least 10 years, you only pay tax on $85 of your original investment. But say that investment grows to $1,000 while it's in the fund. You've now made $900 tax-free. You're not going to pay any taxes on that money. So this is the federal tax code. Kentucky, representatives here, we modernized our tax code a little bit. And Kentucky coupled our tax code with the federal government's tax code, which means that Kentucky will treat your capital gains the same way the federal government does. So if you're not paying taxes at the federal level, you won't be at the Kentucky level as well. So you get double benefits there for investing in opportunity zones in Kentucky. Big, huge benefits for investors here. So what can you put into an opportunity fund? Again, it has to be capital gains, but you don't have to put the actual cash. So say you have $100 in capital gains, you can put that $100 into the opportunity fund. You can contribute $100 worth of property to the opportunity fund. Either of those things work. You can also purchase interest in an opportunity fund from someone else. So say your business partner has an interest in an opportunity fund. At year 5, they decide that they're going to go sail around the world. They just don't want to deal with anything anymore. You can purchase their interest in the opportunity fund and inherit their benefits there. That is something new that just came out with the new regulations in April, that those are transferable, so that's kind of exciting. What you can't do is you can't contribute $100 in services to an opportunity fund for your $100 capital gains. So that means that people like me as an attorney can't do $100 worth of work for an opportunity fund and get interest into that fund, unfortunately. It has to be actual property or money. So what is the point of all of this? And I've alluded to this a few times, but the reason for this law is that there are estimates that there are $6.1 trillion sitting in people's portfolios of capital gains. These are insurance companies, banks, corporations, small family trusts, individuals. It runs the gamut. But $6.1 trillion was just sitting there, not being deployed, hanging out in people's portfolios. And so the authors of this bill, and there were a few people who were working on opportunity zone legislation for quite a while, including a few nonprofits, looked at that and said, how great would it be if we could get that money deployed into these distressed areas who have trouble raising capital? That seems like a perfect marriage. And so that's the point of this bill, is to get, or this legislation is to get that money into these distressed areas, and that's where the tax benefits come from. So I told you that being an opportunity fund is fairly simple. It can be any corporation, any partnership, including an LLC. So you by yourself can form an LLC, you and a partner, you and your family. If you want to go big, there are some big national firms that are have opportunity funds that are investing around the country. But you don't have to get permission from the state, and you don't have to get permission from the IRS or the federal government to be a fund. There's nothing you have to do up front. What you do is you form your fund, and then 6 months after you form, you send a form to the IRS that says, hey, I'm an opportunity fund. And then you have to do that again at the end of the year. So twice a year, you're sending a form certifying to the IRS that you are an opportunity fund, you're up and operating, and you meet the requirements. And we will go through those requirements in a second. I will tell you the IRS is working on more regulations because that's what they do for fun. But they do want to be able to get more information about these funds, who's running them, what they're investing in, how they're operating. So they are working on some regulations now to get more information. That they have told us that those will not be overly burdensome, overly complicated. It just is a transparency, see how well this is working. So they're working on that. But right now, it's just a simple form, send it in twice a year. So to be a qualified opportunity fund, you have to have 90% of your assets in opportunity zones. That really is the big requirement. So say you have an opportunity fund, you formed Me LLC, created an opportunity fund, you raise $100,000, or let's say you raise $1,000. You then have to have at least $900 of that money in projects or in businesses in opportunity zones when you certify the IRS at that 6-month period and at the end of the year that you're an opportunity fund. And again, that's because if people are investing in your opportunity fund, they're getting those big tax benefits. So the IRS wants to make sure that you're actually using that money then to invest in these communities. So 90%, that's the magic number, has to be in the opportunity zones. If you fail to meet that 90% test for whatever reason, you don't lose your status as an opportunity fund. You'll still be a fund, but you get to pay a nice penalty to the IRS that they are still deciding what that will be. So I would advise you to meet your 90% test because they like their penalties.
Can I ask a question?
Sure. If you can hold it to the end, probably better, but. All right. So for that 90% test, what it doesn't take into account is anything you've received in the last 6 months. Because even the IRS realizes that this is the real world. And if you get money in, you can't immediately get it into a business usually or into an investment. Most people have to raise money. It takes some time then to figure out where it's going to go, make the appropriate steps, responsibly invest that. And so for purposes of deciding if 90% of your assets are deployed into an opportunity zone, you don't have to count anything you received in the last 6 months. So that gives you a 6-month window to get money you've received invested into an opportunity zone. If you have a business already, there we go. If you already have a business, you can make that an opportunity fund. You don't have to set up a new business or a new entity to make that an opportunity fund. Anything that you already have will qualify as an opportunity fund so long it can meet that 90% investment into opportunity zone criteria. If you have a business that has investments both in an opportunity zone and outside of it, and you can't meet that 90%, you probably want to set up something separate, but it's not a requirement. So that's how the funds work. That's how they are set up. That's how they're funded. So what can they invest in? And this is kind of what you're all here for today, right? What kind of things can we put in our opportunity zone to get these investments in? Well, pretty much anything, really. Of course, the IRS had to put some regulations on it. Again, going back to trying to make sure that this is used for long-term community development. So the first thing an opportunity fund can do is they can invest in a business that is in an opportunity zone. This is an opportunity zone business. So if you have an existing business or you have a new business that is forming in an opportunity zone, the opportunity fund can then buy stock or a partnership interest in that existing business. The other thing it can do is it can operate a business directly. And that's what you see here. So at manufacturing, or we're here in Owensboro, if they want to directly operate Owensboro barbecue, they can do that. But if they do that, they still have to meet that 90% test. So they have to make sure that 90% of the fund's assets in that business are opportunity zone property. If the fund invests in a business instead of operating something themselves, they have to make sure that business qualifies as an opportunity zone business. And I'm going to throw a lot of numbers out here at you. I will tell you that the paper you have in front of you, the summary you got when you came in, lays all this out. You can refer to that because I will tell you I've read these regulations about 5 times sorting all these numbers out. But so if you are investing, if your opportunity fund is investing in an opportunity zone business, a business in an opportunity zone, you have to make sure that business has 70% of their tangible assets actually located in an opportunity zone. So they don't have to be completely in a zone, but 70% of their assets do have to be in an opportunity zone. That can be in one zone, that can be in multiple zones, just somewhere in a zone. Now, if to be opportunity zone property, it has to be in the zone. It also has to be acquired after December 31st of 2017, which is when that law went into effect. And there's more. If it's a real property, the original use has to be with the opportunity zone business, or it has to be substantially improved. This is all going back. It makes sense if you think of it in the context of they don't want people to get tax breaks for investing in what was already there. You want to make sure they're getting the tax breaks, the tax benefits for investing in new stuff. And so for real estate to count as opportunity zone property, either the original use has to be with the opportunity zone business, and that means that you built the building or the building was vacant for 5 years before you moved into it, or you had to substantially improve it. And what that means is if you buy a building for $100,000, you have to put $100,000 into it. That's what qualifies a building as opportunity zone property. The good news is land is always opportunity zone property, as long as you're using it in your business. You don't have to have original use. You don't have to substantially improve it. And so if you buy 100 acres of land in an opportunity zone, you're going to put your business on it. That all counts as opportunity zone property. You don't have to do anything to it. I can see questions forming. When you're looking at whether a piece of real estate, if it's original use or substantially improved, I think the IRS has gotten this wrong, unfortunately. but they have said that you have to substantially improve each piece of property. So if you buy a piece of land that has 5 buildings on it, you're going to put your business there in an opportunity zone, and you buy all 5 buildings for $500,000. You can't then put $500,000 into, say, the main building and say it's all substantially improved. You have to substantially improve each individual building. So you'd have to value each individual building of those 5 buildings and substantially improve each one. So if each building's worth $100,000, you'd have to put $100,000 into each one to qualify it as opportunity zone property. But remember, only 70% of your property has to be opportunity zone property to qualify as an opportunity zone business. So you don't have to do this for every single one of your assets. The good news is that if you are leasing property, they've actually relaxed the requirements quite a bit. So leased property does count as opportunity zone property. And if you lease property, there's no original use requirement. So you could lease a building that's being used right now, move your opportunity zone business into it, the whole building counts as opportunity zone property right that second. You don't have to substantially improve the property if you lease it. That's fine too. You don't have to put any money into it. You can move into it right now. It's opportunity zone property. The only requirements really are that you have to enter into that lease after December 31st, 2017. Again, they're wanting new capital investment. And you have to use most of that property for your opportunity zone business. It has to be a market rate lease. And you can lease it from related parties. So a related party with the IRS can be, a business partner. It can be a family member. But it has to be in writing. It has to be a market rate lease, and the IRS has been quick to point out that general anti-abuse policies do apply. So if the IRS says, okay, you're technically meeting all the requirements, but there's something wrong here and we're looking into it, they can still disqualify your investment. Now, remember, going back, I told you that an opportunity fund had to have 90% of their assets in an opportunity zone at any given time to qualify. And an opportunity zone business have to have 70% of their tangible assets in opportunity zone property to qualify as an opportunity zone business. Those are the magic numbers. But again, the IRS realizes this is the real world, and we can't get money raised and immediately get it into a business. So the IRS has given basically a 31-month grace period. And so if you have an opportunity fund that is, say, raising money zone months where you can raise money into that fund. You don't have to spend it. You don't have to put it into any kind of property in the opportunity zone or any kind of business. As long as you have a business plan in that 31 months, you have 31 months to get the money raised and then start putting it into an opportunity zone business. So it's called non-qualified financial property. You just have to show the IRS that, hey, I'm raising money. I have this business plan. I am planning on putting it in an opportunity zone. And as long as you eventually do that, you're all good. You get an extension of the 31 months if it's delayed because of the government. The IRS knows the government well, apparently. And so if you can't start your business plan, you can't start, break ground or start building your business within that 31 months because you're having trouble getting a permit or environmental clearance or whatever it is you need to proceed with your business. If that's the government's fault, your 31 months keeps running until that is cleared up. So you get a grace period there. You won't be held up because of some problem with the federal or state government. This is something we're very excited about. I just told you that to qualify as an opportunity zone business that is eligible for these investments, you have to have 70% of your assets in an opportunity zone, right? An opportunity zone property. Well, we ran into some issues with that because here in Kentucky, we have several businesses that were sitting literally on a census tract, or that are several businesses that are building where they were partly in a zone, partly out of a zone. And there's this arbitrary census line running through the business. And it just so happened that 80% of the business was outside the zone, or 70% of the business was outside the zone. And we were very upset because we're like, you know what? These businesses are helping the distressed communities. They're doing what this law intended. They are in the zone. They just happen to be kind of sticking out of it a little bit. They should qualify for these incentives as well, but they didn't because 70% of their tangible assets were not inside the zone on the right side of that arbitrary census line. So Kentucky, as well as several other states and organizations, asked the IRS to change the regulation. we said, look, if a business is literally sitting on a census line, they should qualify as an opportunity zone business. And the IRS actually did change that. So now if you have a business that is sitting on the census line, partly in your opportunity zone, partly out, as long as more of its assets are in the zone than out, it is an opportunity zone business. So it can get investments into the business and its investors will qualify for those tax incentives. So that was a really big deal for us, especially because, like I said, we have several businesses that we're aware of that this affected. And I'm thinking that as you're looking at the areas around your opportunity zones, there may be more that would qualify or benefit from this change. To be a qualified opportunity zone business, so 70% of your 70% of your assets have to be qualified opportunity zone business property, or you have to be sitting on that census line. The second thing is that at least 40% of your intangible property has to be used in the active conduct of your business. I will tell you that no one knows what this means. So this came out in the April regulations as well, the ones that just came out. Several of us have asked the IRS for more clarification. I know what they were going for here. They're going for intellectual property, software licenses. They wanted to make sure that basically the hub of your business is happening in an opportunity zone, or at least a good chunk of it. But there really is no good way to quantify that generally. I expect this to be changed, but I'll make you aware of the requirement right now. The third requirement to be an opportunity zone business is 50% of the gross income of your business has to derive from conduct in an opportunity zone. Again, this is going back, if your business is going to benefit from investors getting these tax benefits, we want to make sure you're benefiting the opportunity zones, make sure you're benefiting these areas that are intended. But there are a few ways to meet that. 50% of your services based on the time that your employees or your independent contractors spend can happen in the zone, or 50% of the services based on how much you pay for them can happen in the zone, or your management functions that are responsible for 50% of your income can be in the zone. So this is important, say, if you have a headquarters operation in the opportunity zone, but then you have distribution facilities elsewhere. If your headquarters operation is responsible for 50% of your income, you still qualify as an opportunity zone business, even though your headquarters may be relatively small as compared to your entire business. If none of those work, the IRS has given you a bit of an out. They say if you can demonstrate based on all the facts and circumstances that 50% of your income is springing from that opportunity zone, you will still qualify as an opportunity zone business. So they've tried to make it very flexible. So those are the three requirements to be an opportunity zone business. 70% of your tangible assets have to be in an opportunity zone, or you have to be sitting on a census line. 40% of your intangible property has to be in an opportunity zone. And 50% of your income has to derive from active conduct in an opportunity zone. If you meet those three things, you're an opportunity zone business. Opportunity funds can invest in you, and the investors get the benefits. Sorry, I'm going to back up one. I didn't mean to skip that. This is also something that came out of the regulations that just came out in April and is very beneficial to a lot of people. Active conduct includes ownership and leasing of real property. So before, it was very unclear if building, say, a real estate property or real estate business would qualify for investment as an opportunity zone business. So if you're building rental houses or office space, that kind of thing. And the IRS operation ownership of real estate does count as active conduct. You can lease that property. The only thing you can't do is you can't have triple net leasing of that property. Anything else absolutely qualifies as an opportunity zone business. So that opens it up to a lot of people, because I know there's a lot of interest around building maybe some housing, some office spaces, some retail spaces, and managing that in these areas. And this opens that up as a possibility. So we now know how opportunity zones were selected. We know where they were. We know how an opportunity fund is set up. We know what an opportunity fund can invest in. But how does an investor invest in the opportunity fund? They can only put the capital gains in there, right? But there are some rules about where those capital gains come from and how long they have to get those in there. So again, a capital gain has to have been derived after December 31st of 2017. If that was the case, then they can be put into an opportunity fund. But investors only have 180 days from the date that they realize that capital gain to get it into a fund. So you have basically 6 months from the time you realize a gain to get it into an opportunity fund to get the tax benefits. That is generally the date that, say, you would sell a stock or whatever else gave rise to your capital gain. In some instances, it would be the end of the year when you've paid taxes. This is where I would advise you talk to your accountant, seek out legal advice, figure out exactly when you are when you're deemed to have realized that gain. You have 180 days from that date. Now, if you have 1231 gains or losses, those are a little special. Those are real estate. Any of you who are dealing with real estate, because those have to be netted, those are deemed to have been realized at the end of the year when you file your taxes. And so if you have real estate gains throughout the year, you actually have 180 days from the end of the taxable year to get those invested into an opportunity fund. So you have a little bit longer on those. So when you defer your gain, it keeps all the same attributes. So if whatever you were going to pay, however it's treated this year, just because you defer it for 7 years, doesn't mean it changes. It will have all the same attributes when you pay those taxes in 7 years, except for the step up in basis. And what all this says in some legalese is basically you can't double dip. So if you have $100 in capital gains, you can't put that same $100 in multiple opportunity funds or otherwise do things with it. You can only use the gains one time. If you get around that, the IRS will come looking for you, I promise you. If you have a partnership or an S Corp or an estate or a trust or one of those kind of organizations that could either pay taxes on their own or they have passed through taxation, either the organization itself can invest in an opportunity fund or they can pass that down to their members. And so say if you have an S Corp that has a capital gain, the S Corp can, from the date it realizes that gain, invest directly into an opportunity fund. They would have 180 days. Or if they elect not to and they pass that gain down to their members, then those members would have 180 days from the date that they realize that gain to get it into an opportunity fund. So it can work either way, just not both. That gain can only be invested one time. So if an opportunity fund, this is a question I get a lot. So an opportunity fund, as the investor, remember, to get the full benefit, you have to keep your investment in a fund for 10 years. Just the way investments work, businesses work, there's a good chance that sometime in that 10 years, the fund is going to want to pull out an investment, put it somewhere else. Something like that's going to happen. A business will liquidate. Something's going to happen. That's okay. If an opportunity fund sells their interest in a business or another asset, that won't affect you as the investor, so long as that opportunity fund reinvests that within 18 months. And so there's some flexibility there for you to keep your tax benefits, even with the natural ebb and flow of the market. Again, anti-abuse rules. This is in there multiple times for a reason, because even if you meet all the requirements, if the IRS decides that you're doing something to try to get around the intent of this law, which is to spur investments and growth in these distressed areas, they can disqualify your investment. This is what I was telling you earlier. Kentucky has coupled our taxes with the federal tax code. So if you get the benefits at the federal level, you will get them at the state level. So if you're getting tax-free growth in your opportunity fund, not paying taxes at the federal level, you will not be paying taxes at the state level as well. Not every state is like that. I think there are 10 that have not coupled. So Kentucky does have an extra benefit for investors there. So the big thing, how do you get investors into your communities? You have projects, you have things that are in these opportunity zones that you can grow, you have ideas. How do you get investors here? First, I want to say, and I always stress this to communities, is don't think you have to go after big investments, big funds. You don't have to go pitch to Wall Street, to DC, to Chicago to get investment into your communities. Remember, these funds are very easy to set up. So you could have a fund for your community. You could have a fund specifically for your business, for your project. There are people here in your community, I assure you, that have capital gains. So you could build your own fund. You could get local investment into your business. So it's not, you don't have to go out and get outside investment. But if you do, and we encourage you to go after it, at least in part, the big thing to remember is that you have to sell your project. You have to sell the community, because these are still distressed areas. The opportunity zone designation mitigates risk for investors, but you still have to show them that it's a good investment. And so what we encourage communities to do is talk to us at the state level about incentives that we might have for whatever project that you have going on, whether it's a tourism or a manufacturing facility or whatever it is. Figure out what you as the locals would be willing to do, wage assessments, or if you'd be willing to donate land or whatever you're willing to do to make projects happen. And look at areas around your opportunity zones as well. Clearly, say here in Davis County, and this is the case with all of our counties, the opportunity zone is only part of your county. There are resources in other parts of your county, other parts of your region that will make those investments very attractive. So don't focus just on your opportunity zones, right? You want to say, well, here in Davis County, we have this great project in this opportunity zone, but you also want to come for our great barbecue and our great riverfront and our great life here. So don't forget about the area outside of your zone. We want to help promote your projects to investors, and we do have investors calling us, everything from, small little funds that are forming here in Kentucky with family trust or individuals up to those national funds. And when they call us, we at the cabinet don't pick winners and losers is how we say it. If somebody calls us and says we want to invest in, say, hotels, we're not going to tell them we have a great project for you, come over here, talk to these people. What we are going to tell them is here are all the projects that we have that we know about that fit what you're looking for. And so what you're seeing here is what we use to build our menu of projects. If you go to the kyoz.com website, you'll see this link and you can post projects. These don't have to be fully thought out projects. This doesn't have to be here. And so we want to know kind of where your project is located, who's in charge of it. It asks for a name. You can make up a name. What kind of project it is. Is it retail? Is it housing? Is it tourism? What is it? Where is it? And all the details about the project. We tell people that this is a starting point. This is basic information. We have a fantastic marketing team at the cabinet. Some of them are here today. I don't know how to do any of this, but they know they're great. Whatever you can send us, whether it's videos or photos or satellite images, we can get it on our website to promote your project here in Owensboro in Davis County, and give us everything you have. We're going to go through some examples in a second, but if you have environmental studies, if the county owns a building that's part of the project, and so it'd be a very easy transfer of that building to a developer, make sure all that information is in there. This is the window shopping. If you go to the kyoz.com website, you'll see projects at the very top of the website. There are projects scrolling across the top of the website. First thing you see. That's because we are trying to be very targeted toward investors, getting investments into these projects. So get your projects up here. Again, this is make it attractive. This is window shopping. What is going to make someone stop, look at your project and say, I want to look at that a little bit more. So here are some of the things we've gotten and some of what we would prefer to get. And I'll tell you that the preferred option or the preferred examples are from Louisville. That is not because we're promoting Louisville over any other community. It's because Louisville was selected by a nonprofit to create a model prospectus for opportunity zones. They were one of 3 cities in the country. We were lucky to have one here in Kentucky. So we used those as the model. There, if you go to, again, the kyoz.com website, there's a step-by-step guide to building something similar for any community in Kentucky. So option 1, we want to build cabins and camping space to attract visitors. Great idea. There are lots of places in Kentucky where that would be fantastic. That doesn't really tell me a lot. A better option would be, show me some satellite images, show me photos of where you're talking about, show me, what's there, what's around it, who owns the land, would it be easy to get to, are there utilities out there already, is it cleared road, has an environmental study been done, whatever information that you might have to make it really come to life. Because if you're looking at this, you can envision what's there, you can kind of think about what you might do there. Option 2, we've gotten quite a bit, is we have 175 acres ready for development. Again, that's good. We have had developers or investors call us and say, I'm looking for X amount of acres to do this project. I don't want anything on it. I just need the land. But again, that doesn't really tell me, is it hilly? Is there a creek in the middle of it? Is it zoned residential or commercial? Better show me a satellite image, show me where it is, show me what's around it, who owns it, what's around it, is it easy to get to, More information is better. This is another example from Louisville where they're just showing everything that they can in a concise area about that project. Number 3, we get this a lot. We have an empty building we want to repurpose. Again, that's good. We have a lot of those in Kentucky, but how big is the building? What does it look like? Again, this is what we're looking for. Who owns it? How big is it? What was it used for before? What could it be used for again? What's around it? Let me see some photos. We need those details. Some of the questions I get a lot, and I hopefully I've answered some of those today, is, why is my area or my county not in an opportunity zone? There actually could be 2 reasons. We have some counties in Kentucky that did not qualify. We have a few counties that did not have any census tracts that qualified as opportunity zones in Kentucky. The other reason would be that your county did not respond to our request for information. And that is not necessarily anyone's fault. We were working with a very tight timeline, but that would be why they're not in there. Can I change my opportunity zone designation, expand it, shrink it, move the borders? Unfortunately not. These are in place until December 31st of 2026, and they can't be changed until that time. This is the question that the answer has changed, and I'm thrilled about it. If you have a project that extends outside of the opportunity zone, again, this goes back to if it's sitting on the census line, if more is in the zone than out, it is an opportunity zone business, and you are good to go. This is kind of the timeline of what we're looking at. You can see we're in 2019 now. You are not behind the ball. This law came out at the end of 2017, and back then we kind of ran out of the gate, started telling people about this. We were all very excited, got our website up and running, and then the regulations did not come out for the IRS until October of 2018. They kept telling us they're coming soon, and it took 9 months for them to come out. And then it took until this past April for the second and meatiest part of those regulations to come out. So you're just now seeing investors really start to move on these because they were waiting for that second set of regulations that really explained how a lot of this would work to come out, and the IRS just got those to us. So 2019 is when things are really starting to move. We expect in 2020 and 2021, you'll see a lot of movement. So we're encouraging people to get going now with getting projects, figuring out what you want to do, but you're absolutely not behind the ball on this. You're not too late to get things done. Again, the website, kyoz.com, where all the information will be, including this presentation and the handout and the PowerPoint, will be on there. We will update that as we get additional information from the IRS. You'll have the projects on there. We're also putting information about opportunity funds that tell us they would like to be listed. So check it out, all kinds of resources. And there's our email address, econdev@ky.gov. If you have additional questions after today, please feel free to email us. And that's just the legal disclaimer of this does include the regulations that have come out, but this is for informational purposes only. We highly encourage you, if you are going to set up an opportunity fund, to seek some qualified legal and accounting advice to make sure that everything is done correctly. That is my information. Again, feel free to reach out to me directly, and I will take some questions. Thank you.
Anyone that has questions, please raise your hand. I'll bring the microphone around to you so people online can get the questions.
Okay, the date of December 26th or December 2026, is that the deadline to invest in opportunity zone? And then your 10 years starts whenever you invest?
Yes, that's a very good question. I'm sorry, I forgot to mention that. So as we said, the opportunity zone designations end in December 31st, 2026, but you have to hold your investment for 10 years to get the full benefit. You're absolutely right. You can invest up until December 31st, 2026. To be very technical, if you realize the gain on December 31st, 2026, you can invest that through May of 2027. And then you have until 2047 to hold that investment before you have to divest it and realize your that gain. Now that only applies to the 10-year. That would exclude the gains from all taxation. When you're talking about the 5-year and the 7-year step up in basis, that only goes until 2026. And so you have to invest fairly early, like by the end of this year, to get that full 7-year benefit. The reason for that is the IRS wanted to give that extra benefit to early investors, early adopters. But you do have until the end of 2026 to invest and get that 10-year exclusion of any gains. Does that answer your question?
You mentioned a while ago that you contribute real estate, not necessarily cash.
Mhm.
I suppose that you're going to establish what your capital gain is with an appraisal. Then you're going to deduct depreciating cost basis in that piece of real estate, and the difference is going to be your baseline for your capital gain.
That is generally how it would work, yes. Can everybody hear that question? Okay. Yeah, that is generally how that would work. That is something new that came out in the April regulations. Before then, it had to be cash. And so, but that, yes, you would have to figure out what the value was of the property that you were contributing to the fund. But you can absolutely, so, if you had $100,000 in capital gains, you wanted to contribute a $100,000 piece of property to it, you could. Does that answer your question?
Yeah, I guess you're going to have to, once you set up the opportunity fund, you'll have to get the property appraised.
Yes.
And deduct what your depreciated cost basis is. That's the gain.
Yes.
And that's the baseline.
That is correct.
I have a follow-up on this question.
Sorry. Yes.
So say you sold that property, would that money go inside that fund? And does that property have to be inside an opportunity zone?
So if you were contributing, let me see if I understand your question correctly. So if you contributed property instead of cash into the opportunity fund, and then the fund sold the property, since the fund would own the property, then yes, the proceeds would go back into the fund. Does that answer that question?
And the property doesn't necessarily have to be in an opportunity zone?
It wouldn't. I'm thinking through this. Remember, only 90% of the fund's assets have to be in an opportunity zone. So technically, you could have a property outside of the zone, but you would still have to meet 90% of your assets in a zone.
So what I'm getting at is stakeholders inside of opportunity zones that typically don't have capital gains,
Mhm.
how can they create their own fund? Typically, they own real estate inside, so if they thereby sell that real estate, even if they have real estate outside of that, they bring money to the fund.
It would still have to be, so the only thing that can be invested into an opportunity fund to get the gains is to get the tax benefits, is capital gains. And so they couldn't just contribute property unless there was a gain associated with that. Maybe I'm misunderstanding your question.
The gains can come from outside.
Yes.
I was following up on this question.
Okay.
So I'm thinking just outside of an investor that has capital gains.
Mhm.
The property we contribute to that opportunity fund, could it be sold and that money be used inside the fund?
Yes.
Is there a limit to other federal monies being put into that opportunity zone with this tax benefit?
That is a great question. And the answer is no. The best way to think about it is this opportunity zone legislation just changed the tax code a little. It's just a provision of the tax code. And so it doesn't change any eligibility for any other programs, anything like that. So new market tax credits, state incentives. And I'm going to, before you leave, is he leaving? I was going to tell you, email me and I'm happy to talk through that a little more with you because it might get a little complicated. But I want to make sure I answered your question. But absolutely, you can use other forms of financing, other state incentives, other federal incentives with this investment. So an opportunity fund investment can be one stream of income. You can still get loans. And we actually encourage people, if you are doing a project in an opportunity zone, you absolutely don't have to come talk to the state before you do it, but we encourage you to do so, especially if it's a tourism project or like a manufacturing facility or something that we normally offer incentives for. Come talk to us before. We might be able to offer additional incentives for that project, but you have to talk to us before it gets started before we can do that. Does that answer your question? Brandon, I think.
Would you guys be able to go to an opportunity zone and a group that may want to invest in an area?
So what we're doing is we are going around the state and doing these in multiple locations. The reason is that we've gotten a lot of requests to come to different groups, and there's only one of me. I mean, the cabinet, we have 70 employees, so it's just the logistics of being every single place. But we're happy to do kind of regional meetings like this. Someplace we haven't done them. So Joe Lilly, who is hopefully watching today, is our Executive Director of Public Relations. He sets all these up. If you'll shoot me an email, we'll certainly see if we can set one up. But we do try to do bigger meetings just to reach as many people as we can. We'll get to you.
If your project is inside a TIF district, are you still eligible for tourism tax credits? Are there any, if you're not, because it's inside of a TIF, is there any exception because of this being an opportunity zone?
You just ask a question that I probably don't know the answer to. So that there are no special provisions in Kentucky law for opportunity zones when it comes to our incentives. I can answer that. As far as how a TIF and the tourism tax credits work together, I can't answer that because the tourism tax credit is administered by the tourism cabinet, not us. I'll be happy if you email me. I'll get you in touch with them, and we can get that answered for you.
Can you explain the timeline again on the funds? 180 days from the time you realize the capital gains, and that's to get the money into the opportunity fund. And then how long would you have to invest that money?
Sure. So you're right. You have 180 days from when you realize the gain to get it into an opportunity fund. The fund then has at least 6 months to get that money invested. Now, a fund only has to have 90% of its assets invested in an opportunity zone, either in an opportunity zone project they're operating themselves or an opportunity zone business at any given time. The 6 months comes in because when you're looking at that 90%, whether 90% of the funds are invested in an opportunity zone at any time, you don't count anything that came in the previous 6 months. So there's basically a 6-month grace window for getting money invested. Does that make sense?
So you have to get your money all invested in that 6 month period?
You do not. So the 90% test, remember, you also have non-qualified financial property. So that gives you 31 months. If you are, say you're raising money in your opportunity fund to start a business or to build a tourism attraction, whatever it is in the opportunity zone, you just have to have a business plan at that point. So you have 31 months to follow that business plan and execute it as long as you're following it.
You have to have the project completed in the 30 months?
You have to start it.
You have to start.
Yes.
Okay. So you got 6 months from the time you realize capital gain
Mm-hmm.
to have put it into the fund, and then you have 31 months to start the project.
Correct. And during that 31 months, you just have to have a business plan, substantially follow that business plan, and then follow through with it.
Thank you, ma'am. Would a commercial land trust have any impact on an opportunity zone? If so, who should be administering it?
Who should, if it's a commercial land trust, who should be administering it?
Or a community land trust? And if so, if it would be beneficial in an opportunity zone, who should administer it?
It really depends on what you're wanting to do. So that might be a conversation we need to have offline a little bit because that could be kind of complicated. But you could absolutely use a community land trust with an opportunity zone to develop through let's try this again, public-private partnership or something like that. But again, that's probably something that's so complicated we're going to need to talk through it offline, if that's okay.
Thank you, ma'am.
Yep.
Do you have to be particular about the paper trail? Let's say an individual investor realized capital gains of, let's say, $100,000, and then that's in their brokerage account. Could they just write a $100,000 personal check to the opportunity zone, or does it have to be shown that it comes from the brokerage account?
So good question. It does not have to be the same money. So if you have $1,000 capital gains, you don't have to use that same $1,000 to put into the fund. You could technically take out a $1,000 loan and use that money. But you do have to show that the gain was there, and then I put that same amount into a fund. Anybody else? All right, and I think you wanted to, where'd you go? Maybe share some information about Owensboro specifically? Oh. There you are. Sorry, I couldn't see you back there. Thank you all very much. I'm going to conclude my part. Don't leave yet. But thank you for coming today. And again, if you have questions, I know this is complicated material. I've been living and breathing it for about a year and a half now. Please feel free to reach out. We will answer your questions. If I don't respond to your email or phone call in a day or two, call me again. It's not intentional, I promise. But we are here to help, and we want to make this very successful for you. Thank you.
If you're interested in knowing more about Davis County tracts that are involved in the zone, you can go to the excuse me, Economic Development website. You can go to the Economic Development website, and under site selection, we have an opportunity page, and it will have more information, some better maps, maybe of what's included in those zones. And it's track 2 and 3 for Davis County. And if you have any questions, you can call our office. There's just links to the information, and then there's also a link to the states zone page. If you have any questions, just let me know.